Good morning, everyone, and welcome to the Ankerstar Wealth Morning Show. I'm your host, Allison Ankerstar, and today we'll be talking about Apple stock, the latest Jim Cramer ETFs, and the difference between time horizon and risk tolerance. But before we begin, as a reminder, this is a financial education presentation and should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. Goldman Sachs says Apple stock is undervalued by 30%. What do you think?
Hey, good morning, everyone, and good morning, Allison. And what a great weekend, especially for the team Ankerstar here. We had our youngest daughter in a volleyball tournament, 6-0 this weekend. So she played well. The team played well. Really excited for them going into the qualifier season, which from now on, you get 3 shots, or you take 3 shots at getting qualified for nationals, which she has every year. But just really looking good going into the season. And exciting news for Allie. Got some midterm grades in for Allie. Everything's looking good, straight A. So good, congrats on that, Allison. And other news, if you didn't know, Allie and I are going to attend a wealth management conference in May as soon as she's out of school for about a week or so. We're going to spend a week in Florida, and it's always great information and learning for me. And if I'm learning, there's certainly a bunch of learning that's going on for Allie too. So very exciting for the team. All right, question is 30% about right for Apple stock, and how much it's undervalued? And I would say at least, right? Because really there's so many ways to win with Apple, and I'm biased, and for some reason the article disappeared there. But you can see the headline is thanks to its services business. So you have great products. You have great phones and MacBooks and AirPods and AirTags and all the other stuff that Apple comes out with for their tech, right? And then you have the service programs. You have the subscription stuff. So you have Apple Care, and you have Apple Pay, where you can take care of your financial stuff, and you also have streaming. You have the Apple TV, which has arguably the best content out there. Currently watching Shrinking. If you haven't, it's for Shrink, so there's psychologists, but it's really a great lineup and a hilarious message, and you'll love the show. And there's several other things that they have out there, and of course there's rumored about the Apple Car coming someday. Maybe that happens, maybe it doesn't, but certainly a lot of ways to win with Apple itself. When you take a look at the chart tends to come back hard every time the market comes back. So what do I mean by that? Well, Apple, 3.5% up on Friday. I'm waiting for the chart to load here. But it runs all the way up to 180, and then it kind of runs back. So you do get your opportunities here. Let's go with a 1-year chart. That's a little more. So I mean, not too long ago, it was down below 130. Now it's up at around 150. But what can you see is Apple is a volatile stock. It's retraced these steps from 170 to 130, back to 170, back to 140, back to 150, 130. So do I think it's through all this? Yes, I do. I think most of the bad stuff's behind us as far as the Fed raising rates, and now Apple can kind of get back to making new highs. So quick math, 30%. So let's see, 150, 10% would be 15 times 345. So 30% higher would take us up to 195, which I think is an all-time high. I'd have to look at that officially. But yeah, that'd be well into the all-time highs, or maybe there was actually nope. Yeah, it would be into the all-time highs for Apple stock. So I think that's very achievable and more. That's why we keep it as our number one personal, as well as number one holding in the book. As far as price to earnings ratio, it's a tech firm sitting at 25 PE. Again, the banks and car companies and stuff tend to sit in the low teens. Tech firms are generally up around 50 or so. So this being the leading tech firm on the planet, I think it is grossly undervalued. That's why I love being a shareholder. And you do get a little bit of a dividend. For a tech stock, you get a little bit of money coming in, and if you hold a bunch of it, then you get a decent amount. I've already told you, Ankerstar Wealth, we're at new highs in the book, largely because Apple's up 16% for the year, and obviously it carries our largest weighting for now. but it won't forever, right? There will be a time to rotate from Apple. We had the investment advisory board have a kind of a working meeting last week, and we talked about there may be a time to rotate or reduce our position in Apple, but I don't see that being anytime soon.
Next, legendary stock picker Jim Cramer has built an army of both followers and haters, and now ETFs are available for both. What can you tell us about those ETFs?
Yeah, so that's Jim Cramer. He's getting up there in the years now. I started following Cramer back when he started his Mad Money show, which I don't even know how long that is, but it's been probably 2 decades, at least a decade and a half, because I remember the 10-year celebration of his show. But Cramer, everybody serves a purpose, right? And his purpose was, and I read his books from back in the day, Harvard educated and went right into managing money early on, managed a hedge fund, that sort of thing, made some books. His books are always very informative, if you will. I think they're timeless lessons and timeless fundamentals that he teaches there. And I've largely followed those. But his purpose was to bring the individual stock back in vogue, if you will. We went for years where, if you think Warren Buffett and cigarette butts and, picking up the undervalued stuff, well, that was easier to do when you had to go to the library and look at outdated information to pick your stocks. Well, now you have everything at your fingertips, right? And everybody has the same thing. It's not like you have anything more than David Einhorn has, right? I mean, literally it's all there. You just have to sort through it and make your best analysis and decisions off it. Well, we went from the, stock picking was how you invested for years. Then we hit, the 80s scene, and it was mutual funds. And it was you're dumb for even trying, you just take your C and move on, meaning take the average and move on. And he pushed back against that. He said, well, if, the top 50 stocks give you an average, is it possible to pick the top 20 of those 50 and then outperform? And he said, yes. And I will say unequivocally, yes. I mean, that is literally just math. The fact that an entire advertising campaign for 2 to 3 to 4 decades makes people believe that they can't do it and that it's not possible and that no one can is a huge advertising boon for them, because that way you just go, okay, can't be done. Well, let's just give all our money to the big box investment firms. Ridiculous concept. People bought it hand over fist. I still hear it every day. You can't beat the SPY. Nobody can. I'm like, are you even hearing yourself? Right? Are you even hearing yourself and what you're saying, that nobody can beat the averages? The average, right? Anyway, it just don't get me started. But anyhow, back to that was his point. Well, he started picking stocks and has this show, Mad Money, and of course he's on CNBC every single morning, talking about individual stocks. Well, there was a time where people would ask, it's just like, hey, if you like this long Cramer, I'll put it in blue here for you, this long Cramer ETF now exists, but people would say, if you followed everything Jim Cramer said, like if he talked favorably about the stock, you bought it that day and you held it until he ever said something bad about it and then you sold it, right? Or the other thing, if he said don't buy it, you short the stock, right? And basically he would pontificate, and now he says a lot. And of course, I've been there now, where you like something this week and don't like it the next week because something changed, right? But the people said, I wonder if you bought all the stocks, how would you do? Would you outperform? Well, they now have a Cramer ETF officially, that if you want to be, it's LGIM, so long Jim, if you will. And it will basically, if Cramer says buy it, it buys it, right? And then you have the inverse Cramer, because that's where on especially Twitter, where people who like to sling hate tend to live, it seems. But if you go onto Twitter, it's just like, people would talk about the inverse Cramer. It's like, hey, this year's a year of inverse Cramer. Well, I will tell you, and being a largely tech investor myself, that when tech is out of favor, it is very painful. So all last year, 2022, the inverse Cramer would have outperformed. I look at these things as a complete financial gimmick. They are more towards speculation and gambling than they are towards actually, investing a company and buying shares so you can be part owner of the company. type of investing. So if this stuff interests you, then, well, you're going to be off to the next shiny thing in 5 seconds anyway. But you can check these out if you're more curious than anything. Click on it, go to the top 10 holdings. You can at least see what Jim is certainly for and what he's against, or flip on CNBC for 5 seconds. You can find out the same thing. But in the world, I'll close this question with this, is that as much as the financial world should be completely respected as the guardians of capital and wealth for not only the largest institutions in the world, but for households and families around the world, the importance of the job cannot be understated, that you take it seriously and do it correctly. And unfortunately, I think these ridiculous things just show that even in the financial world, there's a bunch of clowns and that will do anything to make money, right? And that to me is sad, and it goes against my fiduciary responsibility. So anyhow, I wouldn't want to support these, even if I like the way they were thinking, just because I think it's a financial shenanigan. So I'll leave it with that.
Last, time horizon and risk tolerance are often confused. What can you tell us about the difference?
Well, I will tell you they are confused, and we'll start with risk tolerance. So risk tolerance, I think people get. And this whole question spurs out of a situation to where one of the advisory team here at Ankerstar Wealth was in a discussion with a client's like, well, I want to move my account. Well, they had to call the old advisor to do it, which is rare that you have to do that. But anyhow, they had to make a phone call to the old advisor, and both of them were on the line. And the old advisor, instead of back to that responsibility, is if you lose a client, and that phone call or email or whatever, you respond with professionalism, empathy. Sorry, you didn't have a better experience. How can I help you transition to a better experience? That's a professional thing to do. On the inside, yeah, whenever you lose business, you're mad, right? I mean, whatever, you're human, but you don't share that. I mean, you support the client, say, hey, if you found a better solution, how can I help you get there? And best of luck. Period. Dot. Close the books. That's the answer. Don't sit there and be some sort of loser on the phone. And that's what this person did. In particular, this happened to be a she, and she said, "Hey, what are they doing that we're not already doing for you?" And unfortunately, a more seasoned advisor isn't going to take that question. You'll simply transition like, "Hey, I appreciate your concern. We've already made the decision here, so let's please let's go forward on our path," right? But anyhow, got into a little bit of a discussion with the old advisor she's like, well, we already have invested with in accordance with this time horizon. And our advisor very definitely said, well, that's the problem, is it's only one factor that goes into risk tolerance. And you do have investors. He's young, and you have invested with this time horizon, which is forever. So you've got him all amped up on risk. So therefore he's just losing, money hand over fist, because you're only looking at time horizon and nothing else, not even trying to mitigate the losses whatsoever. So let's talk about risk tolerance. Risk tolerance really is your own personal beliefs with how likely you are to stay with your investment goals. So a risk tolerance that's all the way to the right, like unbelievable risk tolerance, is generally somebody that's either a lifelong investor or educated at an early age about risk and really understands that, hey, if I just hold this through, I can simply add when the market's off, no big deal. That's not a lot of people, to be honest. A lot of people have emotions that creep into their decision making, and therefore they need some assistance on, hey, if you leave it to your emotions, you will wait for the market to sell off, and then you can't take it anymore and you'll sell. That's called selling low. And then you won't buy back in until the market screams back higher and it's hitting new highs. And that's called buying high. That's opposite from what you should do. You should buy things on sale and sell them when they're higher. Or just hold them forever, just acquire when they're down low, right? So that's why people need help with this risk tolerance thing and to talk through it. So it's very important you kind of understand your own risk tolerance. And I will say this, if you misassess the risk tolerance, that's when people go to cash. They're like, okay, screw it, I'm out, right? I quit investing. I relate this analogy. It would be like somebody who, say in their neighborhood, somebody was in a bad car accident and was either hurt or killed, right? And at that point, that person takes that data point and says, you know what? The riskiest thing I do every day is hop into my vehicle. That's true. right? Riskiest thing we do every day is driving a car. So at that point, the person says, you know what, based on that one incident, I'm going to sell my car and I'm going to walk 3 miles every day to work. Are they wrong? No, it's a lot safer to walk 3 miles every day to and from work than it is to get in your car from a safety perspective. Same thing with investing. It's safer to never invest. Now, are you crushing your life as far as how much you can achieve because you've gone so safe that you've decided you would spend, you walk 3 miles an hour, that takes an hour walk there, an hour walk back every day. You can do that. But same thing with investing, one data point or one punch to the nose as far as the market. If you're out for the rest of your life, you're leaving, hundreds of thousands of dollars on the table. So you don't want to misassess that risk tolerance. And that's why you do have to adjust it, especially when you have down years like 2022. You need to kind of mitigate it to where it's like stick to your goals, just, lower level and, lower level goals for right now, because when the market shifts, then you can go back out on the risk spectrum. So something to think about. I will throw this out here when I say it's not the only thing to consider. If you look there at blue, I'll bring it up to the top here. Age, which is time horizon, is one of the core components of risk tolerance, but it's not. It's just one of three, right? Investment goals. What are you trying to do? People are like, well, you need to make more money. Well, I don't know. There's a lot of people who actually have a number out there in mind that is enough money. And once you've made that money, then you can dial down your risk, right? And then income. If you got a big, nice high paying job, you can afford to take more risks. So you can afford to have your money working harder for you. So these are just a few things you take into consider, but it's not just time horizon. And so beware your 401k is the point. They have you invest generally based off of what do they know? They know your time horizon. They know how old you are. They have no idea because they probably haven't ever talked to you personally about your risk tolerance, right? Where you clicked it once when you started working there. It's like, whatever, I'm not looking at that for years. But it's basically a time horizon sort of thing, which can be way out of whack with your risk tolerance. So anyhow, good question coming in and wanted to share that with you guys today.
Thank you, everyone, for your questions. Please submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's all we have for today's show. I'm Allison Ankerstar, and we'll see you back here tomorrow.